When you have a retirement plan like a 401k at your job, you might have a vesting schedule or a vested account balance that's different from your normal account balance. So we're going to talk about what exactly that means and how it works, and be sure to stick around as we get into some details that might help paint the picture with some specific vesting schedules and different money types and that kind of thing. The vested account balance is the amount that you actually own in your retirement account. So that might be the amount you can actually take with you when you leave your job, or it could be money that's available to you if you want to take a loan against your account balance, or if you want to take a certain type of withdrawal, like a hardship withdrawal from your 401k. Once the money is vested, it cannot be taken back. So you would not forfeit that back to your employer once it becomes vested. The reason that employers do this is they might want to encourage you to stick with your job maybe for another year or two or a couple of years, because the longer you stick around, the more vested you are in your account. So this provides an incentive for you to stay on the job so they don't have to put time and energy and money into finding new employees. And it can also help your employer reduce costs on the retirement plan. But most importantly, this is the money that you actually own. You can think of the money in your account in two broad categories, and one of them is an employee contribution. That's the money that you actually put in out of your paycheck, for example, if you choose to contribute 10 or 15% of your earnings to the 401k plan. That would also include money that you might roll in from, let's say, a previous job's 401k. You can count that typically in your vested account balance. But the money that you contribute out of your pay is always 100% immediately vested. Then there are employer contributions, and this is money that your employer puts in on your behalf. So that could be a matching contribution, like if you put in 4%, they put in 4%, or there might be profit sharing contributions or other types of contributions. And those are the types of contributions that are most likely to have a vesting schedule. So you might need to stick around at your job for a certain number of years. So when exactly can you take the money out? We're going to get into the years of service in a minute, but the vested money is available to you while you're working through loans, for example, or a hardship distribution, or some plans let you do an in-service distribution after age 59 and a half, where you could take money out and maybe put it into an IRA with lower costs, for example. That's something that I do with clients sometimes. When you leave your job, you also get to take that vested money with you. You could move it over to your next job or to your IRA, or you could cash it out. All of these different choices have different tax consequences, so you want to evaluate those carefully. But your vested balance is available after you stop working at your job. There are a couple of other situations where you might be able to get the money out, but that covers most of them: when you quit working, when you retire, or when you want to access the money in your plan. So let's do a quick example here. Let's say that you have $100,000 in your 401k at your job and you are 60% vested. So how much of that money would you get to take if you leave your job? Let's say you retire with that 100,000 in there. Well, the answer is, of course, you'd get to take 60% of that, or $60,000. So we've got the circles there shaded in at about 60%. Some of that might be forfeited back to the employer. But if you stay in your job for another couple of years, you might eventually have access to the full 100%. So let's talk about those vesting schedules. Again, any employee money that you put in, for example, the amount that comes out of your paycheck, is 100% immediately vested. There might also be employer contributions that are 100% immediately vested as well. So if your plan uses a safe harbor contribution, that would typically be 100% immediately vested. You would be entitled to that money if you leave your job. Once you are essentially entitled to the money, it doesn't even need to necessarily hit your account in some cases before you leave your job. A typical vesting schedule is the 6-year graded vesting schedule, because that satisfies certain rules. So with that, you are 0% vested after the first year, then 20% after the second year, then 40%, 60, 80, and 100% after 6 years of service. We're going to talk about a year of service in just a minute. There is also cliff vesting, and that might be 0%, 0%, and then 100% after 3 years. And then there are a number of other vesting schedules that your employer can do. Basically, they might take the 6-year graded schedule and do something that is more generous than that. And as long as it is more generous, then the IRS and Department of Labor don't have a problem with it. So they might say 25% per year, and that way you would be fully vested after 4 years instead of 6. It's important to know what exactly a year means. You might think of it as 12 months, 365 days, but it is typically going to be a calendar year in which you have 1,000 hours of service. So that can be tricky if you get hired sometime in the middle of the year. You might not know if you're going to hit 1,000 hours or not, and that's going to affect whether or not you get a year of service credited to your vesting, and that's very important. By the way, before I forget, please subscribe to this channel. It doesn't cost you anything to do that, and it helps you stay up to date on things like this. It also helps me out a tiny bit, so thank you for doing that, and thanks to everybody who's already subscribed. There are also these IRA-based plans that are effectively like 100% immediate vesting. So once the money goes in there, you could take the money right back out whenever you want. For example, that might be a SEP or a simple plan. Those are employer plans, but they're different from your 401k and your 403b. So again, you could take the money out. There might be some taxes due. There might be tax penalties. There could be some restrictions related to whatever product the money goes into that your employer is using, but there wouldn't be a vesting schedule that prevents you from taking that money out. So I hope this information is helpful. If it is, please leave a thumbs up. That helps to get the word out to other people. It helps to let me know that I'm on the right track. And again, hope you got a lot out of this, and take care.